Hello from Trend Signal for our review of the data and events the week beginning the 7th of August. Monday morning, markets steady overnight following the pickup in US markets. The Dow made I think it was the 8th consecutive record high following the better than expected non-farm payroll data. The broader S&P 500 closed close to record highs as bond yields and the dollar moved higher in response to the stronger data. The financial press on Monday morning are covering the 10th year anniversary of the Great Recession, as it's now referred to as by historians, August the 9th, 2007, close to 10 years on Wednesday, that is. According to the FT, this started when BNP Paribas barred investors from accessing money in funds with subprime mortgage exposure. That's the first time that the mainstream press heard about subprime mortgages, saying that there was a complete evaporation of liquidity. The gist of the article was about the 150 billion worth of fines levied on banks, which is extraordinary, really, but highlights the fact that very few executors have been held to account. I guess it's easier finding the institutions than to go after the individuals. So shareholders paid the price for incompetent and, in some cases, dishonest executives, and the rest is history. Not that many believed we'd be here 10 years later, with rates still at record lows across the whole of Europe. And with solid growth in the US, rates still only at 1%. I remember back in 2009, the markets, the Bank of England saying that the markets may not normalise until 2015. Even then, I think most people were pretty shocked at the time scale, but seems they were all wrong, including myself. Markets had a reasonably positive week last week. Certainly equities did pretty well. The FTSE and European bourses generally rebounding on a stronger dollar or a weaker euro and weaker sterling. The Nikkei pretty much flat following a fairly flat move in the Japanese yen. Strong unemployment data on Friday last week, posting 209,000 new jobs versus 182,000 expected, with a slight revision up in July's numbers. But I think whilst this supports the notion that the Fed will raise rates for a third time in December, it's by no means a probability. The Chicago Mercantile Exchange's own tracking site that takes Fed funds rates, future Fed funds rates, to calculate it. The probability of a rate rise in December is still only at 47%, albeit up from 42% the previous day. But there's got to be other reasons for this surge in the dollar than just that. Precious metals and gold and silver all slipped last week following the rebound in the dollar, which is what you expect. Oil had a pretty choppy week, really, but oil inventories last week was slightly worse than expected. Still a drawdown, but a smaller drawdown than expected. The dollar, the dollar strengthened, I think, as I said, not just because of the non-farm payroll. I think the move suggested that it was quite a crowded short trade on the dollar, and I think, that would be expected, like it was expected at the beginning of the year when everyone was very much long the dollar in a very crowded long trade. The economic data has been good in the US, strong employment numbers, but I think they've been offset largely by low wage growth, which remains a bit of a conundrum. Certainly it looks like inflation is going to be the driver for rates in the US. Certainly as a tip in terms of its tipping point. The markets have sort of discounted an unpopular president who's struggling to get any traction in his key policies. Of course, that may change, but I think the Fed will have all eyes on inflation. So let's have a look at the data out this week. It's particularly sparse, as it always is following the non-farm payroll data. Nothing until Wednesday. We start with the crude oil inventories. Market will be particularly sensitive there to any further significant drawdown in inventories. Of course, with price rebounding, $9 from a couple of months ago, I'm sure the shale oil business in the US will be stirring even more. Overnight on Wednesday, we have the last meeting held by the current chairman of the Reserve Bank of New Zealand. Rates are expected to be kept at record lows in New Zealand. We'll find out Thursday morning. We have at 9:30 UK manufacturing production data. A flat number is expected there. And then we have the first number that will tell us where prices are going in the States. This is the producer price index, which is the cost of goods and services going into production. So it's sometimes regarded as a leading indicator of inflation. Very flat number expected there, plus 0.1%. Then on Friday, the main event, in what is a particularly quiet week, we have the Consumer Price Index, or inflation data in the United States. It's the core number we're looking at. Plus 0.2% is expectation. I guess anything perhaps 0.3, 0.4%, that might tip the markets into starting to be a little more concerned about inflation, and that would result in a more notable move in the dollar. We'll have to wait to see, won't we? That's it. Thank you very much for listening. Cheers. Bye now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.